Before we dive in, a quick but important note. This video is for educational and informational purposes only. I am not a financial advisor, mortgage broker, or accountant. The information presented here is not financial, legal, or tax advice. Every homeowner situation is unique, so please consult with qualified professionals before making any financial decisions regarding your mortgage. Your home mortgage is very likely the single largest, most expensive, and potentially dumbest debt you will ever take on in your life. Now that sounds harsh, but stick with me, because it's only the dumbest debt if you treat it like a 30-year prison sentence. If you treat it like a one-and-done deal that you're stuck with until the bitter end. Think back to the day you closed on your home. Remember that moment? The sheer excitement mixed with a healthy dose of terror. You sat at a long table, staring at a mountain of paperwork that felt like it was a foot high. You signed your name so many times your hands started to cramp. And somewhere in that stack was the promissory note, the legally binding document where you agreed to pay a specific interest rate every single month for the next 360 months. Felt incredibly final, permanent, like a financial tattoo. But what if I told you that signature wasn't the end of the story? What if it was just the opening bid in a negotiation you didn't even know you were in? A negotiation that could put tens of thousands, or even hundreds of thousands of dollars, back into your pocket over the life of your loan. That negotiation, that financial do-over button, is called refinancing. And for millions of American homeowners, it is the single most powerful and criminally underutilized tool for building wealth and achieving financial freedom. The problem is, the entire mortgage industry is built on complexity. It's designed to be confusing. They use jargon like LTV, DTI, ARM points, and amortization schedules to make your eyes glaze over. They want you to think it's too complicated, too expensive, or too much of a hassle to change the deal you originally signed. They are perfectly happy for you to just keep making that same payment month after month, year after year, without ever questioning if you could be doing better. Well, today that stops. This is the start of a journey to pull back the curtain on the entire refinancing process. We are going to demystify it, simplify it, and give you the confidence to take control of your single biggest expense. Our goal is simple: to transform you from a passive debtor into an active, informed manager of your own financial destiny. We're going to turn that mortgage from a liability that drains your bank account into an asset you can actively use to your advantage. So, what are we talking about big picture? Refinancing is simply the process of replacing your existing home loan with a brand new one. That's it. You're not selling your house. You're not moving. You're just swapping out your old, potentially outdated and overpriced loan for a new, better one. Think of it like your cell phone plan. Remember 10 years ago? You probably paid $100 a month for a tiny amount of data and a limited number of text messages. Today, you can get unlimited everything for a fraction of that price. You wouldn't still be paying for that old, terrible 2014 cell phone plan, would you? Of course not. You'd switch providers or upgrade your plan in a heartbeat to get a better deal. Your mortgage is no different. The deal you got 2, 5, or even 10 years ago might have been the best you could get at the time. But things change. The most important thing that changes is the interest rate environment. The rates offered by banks go up and down like a roller coaster. If rates have dropped significantly since you first got your loan, you could be massively overpaying every single month. But it's not just about the overall market rates. Your personal financial situation has likely changed, too. When you first bought your house, maybe your credit score was just okay. Maybe you had a smaller down payment. The bank looked at you and said, "Okay, you're a bit of a risk, so we're going to charge you a higher interest rate." But now, maybe years have passed. You've been making your payments on time every single time. Your credit score has shot up. You've gotten raises at work, increasing your income. You've paid down a chunk of your mortgage, building up equity in your home. In the eyes of a lender, you are now a completely different borrower. You're no longer a risk, you're a prime top-tier customer. And you deserve a prime top-tier interest rate to match. Sticking with your old mortgage is like having a perfect driving record, but still paying insurance premiums like a 16-year-old who just crashed their parents' car. It makes no sense. This is the core of why refinancing exists. It's your opportunity to have the market and the lenders reevaluate your situation and offer you a new deal based on who you are today, not who you were years ago. So what can this new, better deal actually do for you? This is where it gets exciting. There are 3 primary game-changing benefits that a successful refinance can unlock. First, and this is the one everyone thinks of, is lowering your monthly payment. This is the most straightforward win. By securing a lower interest rate, you can slash your monthly housing cost, sometimes by hundreds of dollars. Imagine what you could do with an extra $300, $400, or $500 in your pocket every single month. That's money you could use to pay down other high-interest debt like credit cards or student loans. You could finally start building a real emergency fund. You could invest it for your future, or simply use it to reduce financial stress and enjoy your life a little more. This is immediate, tangible relief that you feel in your budget from day one. Second, you can shorten the term of your loan. This is a powerful wealth-building move that most people overlook. Let's say you're 10 years into a 30-year mortgage. You could refinance the remaining balance into a new 15-year mortgage. Now, your monthly payment might stay the same or it might even go up slightly, but you will be paying off your house 10 years earlier. 10 years. Think about that. An entire decade of your life without a mortgage payment. But the real magic is the interest savings. Because you're paying the loan off so much faster, the total amount of interest you pay to the bank over the life of the loan could be cut by $100,000 or more. This is how you build real generational wealth. You stop renting money from the bank and start owning your home, free and clear, years ahead of schedule. And third, you can tap into your home's equity. This is what's known as a cash-out refinance. Over the years, as you've paid down your mortgage and as your home's value has hopefully increased, you've built up equity. That's the portion of the home you actually own. It's your wealth, but it's trapped inside the walls of your house. A cash-out refinance allows you to take out a new, larger mortgage and receive the difference in cash, tax-free. People use this cash for all sorts of smart financial moves. They use it to pay for major home renovations that increase the value of their property. They use it to consolidate all their high-interest credit card debt into one lower-interest, manageable monthly payment. They use it to pay for a child's college education or to start a business. It's a way to unlock the value you've already built and put it to work for you in the here and now. Lower your payment, shorten your loan, or tap your equity. These are the three pillars of refinancing. It's not just about shuffling paper. It's about fundamentally restructuring your financial life for the better. Now, I know what some of you are thinking. This sounds great, but doesn't it cost a lot of money? Aren't there thousands of dollars in closing costs? That is the number one myth that stops people in their tracks. And yes, there are costs involved. You're essentially taking out a new loan, so there are fees for things like appraisals, title insurance, and loan origination. But here's the critical part you have to understand. You must look at refinancing as an investment, not an expense. You have to ask yourself, will this investment pay for itself? We do this with other things in our lives all the time. You might spend a little more on energy-efficient windows because you know they'll save you money on your heating bill for years to come. It's the same principle. You calculate what's called the break-even point. If the closing costs are, say, $5,000, but your new loan saves you $250 a month, you divide the costs by the savings. In that case, it would take you 20 months to break even. After that 20-month mark, every single dollar you save is pure profit straight into your pocket. If you plan on staying in your home for longer than 20 months, making that investment is a financial no-brainer. Over the course of this journey, we are going to arm you with all the knowledge you need. We're not just scratching the surface. We'll dive deep into the different types of refinance loans, from conventional to FHA to VA. We'll show you exactly how to calculate that all-important break-even point for your specific situation. We'll teach you how to shop for lenders to ensure you get the absolute best rate, and how to spot and avoid junk fees. We'll walk you through the entire application and approval process, step by step, so there are no surprises. By the time we're done, you will have a complete roadmap. You will be able to look at your own mortgage, look at the current market, and decide with 100% confidence if refinancing is the right move to slash your monthly payments, pay off your house years sooner, and unlock the wealth that is rightfully yours. So let's start with the most important question of all. What exactly is a refinance, and why has your bank been hoping you'd never ask? At its core, a refinance is shockingly simple. You are trading in your old mortgage for a brand new one. That's it. Think of it like your first cell phone plan from 15 years ago. You paid a fortune for a tiny amount of data and a handful of minutes. It was the best deal at the time. But today, you can get unlimited everything for a fraction of the cost. Would you stick with that old, expensive, clunky plan out of loyalty to the phone company? Of course not. You'd switch in a heartbeat. Your mortgage is no different. It's a financial product, a contract you sign based on the market conditions and your financial situation at that specific moment in time. But time passes. Markets change. Interest rates fall. Your credit score improves. Your income goes up. The contract that made sense 5 or 10 years ago might be a financial dinosaur today, quietly draining hundreds or even thousands of dollars from your bank account every single month. Refinancing is the act of getting a new, better loan with a new, better interest rate or better terms, and using that new loan to completely pay off and eliminate the old one. You're not just tweaking your old loan. You are replacing it entirely. One day you have mortgage A, the next day it's gone, paid in full, and you now have mortgage B. Same house, same you, but a much smarter financial deal working in your favor. So, if it's that simple and beneficial, why isn't your bank sending you a letter every month begging you to do it? This brings us to the second part of our question. Why have they been hoping you'd never ask? The answer is the simple, brutal truth of banking. Your mortgage is not a partnership. It is a product. And you are not a partner. You are a customer. The bank's primary goal is to make a profit, and the interest you pay on your loan is one of their biggest and most reliable sources of profit. When they gave you that original loan, they ran a calculation. They projected exactly how much money they would make from you over the next 30 years, assuming you just kept paying month after month, year after year, without asking any questions. Every single interest payment you make is revenue for them. Let's put some real numbers to this because this is where the scale of it all becomes crystal clear. Imagine you bought your house with a $400,000 mortgage at a 6.5% interest rate. Over 30 years, you'd pay your monthly principal and interest and everything would seem fine. But if you were to actually calculate the total interest you would pay over the life of that loan, the number would be staggering. You would pay the bank over $510,000 in interest alone. That's on top of the original $400,000 you borrowed. Your $400,000 house would actually cost you more than $910,000. Now let's say that a few years have passed and interest rates have dropped. You could now qualify for a new 30-year loan at 4.5%. If you refinance into that new loan, the total interest you'd pay over the 30 years would be around $329,000. Did you catch that? By making one smart move by refinancing, the difference in total interest is over $181,000. That is a life-changing amount of money. That's a college education for your kids. That's a comfortable retirement. That's a business you could start. That is $181,000 that would have gone straight from your pocket into the bank's profit column, but instead it stays with you. That is why your bank is quiet. They are in the business of selling money, and they sold you their product at a 6.5% price. They have absolutely no financial incentive to voluntarily offer you the new lower 4.5% price. They are perfectly happy for you to continue paying the higher rate for the next 25 years. It's not personal, it's just business. But your financial future is personal. And understanding this dynamic, that you are the one who has to be proactive, is the first step to taking control. So, now that we understand what a refinance is and why it's up to you to initiate it, let's look at the 3 main reasons, the 3 powerful levers you can pull when you refinance. Most people think it's just about getting a lower monthly payment, and while that's a huge benefit, it's only one piece of the puzzle. The first and most common lever, as we've discussed, is securing a lower interest rate. This is called a rate and term refinance. You're not pulling any cash out. You're simply swapping your old loan for a new one with a better rate, a different term, or both. If market rates have dropped since you got your original loan, or if your credit score has significantly improved, you are a prime candidate. Even a 0.5% drop can save you tens of thousands of dollars over the life of the loan and reduce your monthly payment, freeing up cash for savings, investments, or just breathing room. The second powerful lever is changing the loan term. This is a strategic choice that depends entirely on your personal financial goals. Most people start with a 30-year mortgage because it offers the lowest monthly payment. But let's say a few years have passed. You've gotten a raise, you're more financially stable, and your priority is now to own your home free and clear as fast as possible. You could refinance from your 30-year loan into a 15-year loan. Now, your monthly payment will likely go up, and that sounds scary. But the magic is in the interest savings. Because you're paying the loan off in half the time, the total amount of interest you pay to the bank is slashed dramatically. You build equity at lightning speed and you achieve the incredible milestone of owning your home outright decades sooner. It's a move for financial acceleration. But what if you're on the other side of that coin? What if life has thrown you a curveball? Maybe you've had a reduction in income, or new expenses like childcare or medical bills. You're feeling squeezed every month. In this case, you could do the opposite. If you're, say, 10 years into a 30-year mortgage, you could refinance into a brand new 30-year mortgage. This would reset the clock, stretching your remaining balance over a new longer period. The result? a significantly lower monthly payment. Yes, you will pay more in total interest over the long run, but the immediate monthly relief can be an absolute lifeline. It can be the difference between keeping your home and facing foreclosure. It's a tool for financial stability when you need it most. This brings us to the third lever, and for many, it's the most exciting one. Tapping into your home's equity with a cash-out refinance. First, what is equity? In simple terms, it's the portion of your home that you truly own. It's the current market value of your home, minus the amount you still owe on your mortgage. If your home is worth $500,000 and you owe $300,000, you have $200,000 in equity. For most American families, this equity is their single largest financial asset. But it's trapped. It's on paper. You can't use it to pay for college or fix your roof. A cash-out refinance unlocks that value. Here's how it works. Instead of just refinancing the $300,000 you owe, you might take out a new larger loan for, say, $350,000. You use the first $300,000 from that new loan to pay off your old mortgage completely. And the remaining $50,000? That comes to you as a tax-free check. People use this cash for incredible things. They do major home renovations that increase the value of their property even further. They consolidate high-interest debt, taking all their 25% interest rate credit card balances and paying them off with this new low single-digit mortgage rate debt. A brilliant move that can save thousands a month. They pay for a child's wedding or education. They start a business. They create an emergency fund. They are literally converting the illiquid wealth stored in the walls of their house into liquid cash they can use to improve their lives. So you have these three fundamental levers: lowering your rate to save money, changing your term to align with your life goals, and tapping your equity to unlock your wealth. Each one is a powerful tool designed for a different purpose. But this all sounds a little too good to be true, doesn't it? A lower payment, a shorter term, a pile of cash. What's the catch? What are the costs, the fees, the hidden traps that can turn a smart financial move into a costly mistake? In the next part, we're going to pull back the curtain on the closing costs and fees that lenders don't want you to scrutinize, and I'll show you exactly how to make sure your refinance actually puts money in your pocket, not theirs. Alright, let's pull back that curtain. Because the single biggest trap in refinancing isn't the interest rate you see advertised on a billboard. It's the mountain of fees hidden in the fine print. Lenders love to talk about your new low monthly payment, but they get awfully quiet when you start asking about the thousands of dollars it costs to get there. These are the closing costs, and they are the gatekeepers that determine whether your refinance is a brilliant financial move or a slow-motion disaster. Think of it like this: you found a great deal on a flight to Hawaii. The ticket price is amazing, but then you get to the checkout page and suddenly there's a seat selection fee, a baggage fee, a fuel surcharge, and a convenience fee. All of a sudden, your great deal isn't so great anymore. Closing costs are the baggage fees of the mortgage world, and if you don't know what to look for, you're going to overpay. So let's break down this hidden price tag line by line. The first and often biggest fee you'll see is the loan origination fee. This is the lender's payday. It's the fee they charge you for the service of creating your loan, for doing the paperwork, underwriting, and processing. It's typically calculated as a percentage of the total loan amount, usually somewhere between 0.5% to 1%. On a $300,000 loan, that's $1,500 to $3,000 right off the top. This fee is pure profit for the lender, which also means it's one of the most negotiable fees on the list. Remember that. Next up, you'll likely see an application fee. Sometimes this is bundled into the origination fee, but some lenders list it separately. It's exactly what it sounds like: a charge just to submit your application. It can be a few $100s, and it's meant to cover the initial administrative costs of starting the process. Then comes the appraisal fee. This one is important. The lender isn't just going to take your word for what your house is worth. They need to protect their investment. So they hire an independent, third-party appraiser to come to your home, inspect it, compare it to similar homes that have recently sold in your area, and determine its current market value. This costs money, typically anywhere from $300 to $600, or even more for larger or more complex properties. This fee is critical because the entire refinance hinges on the outcome. If the appraisal comes in lower than you expect, it can reduce the amount of money you can borrow or even kill the deal entirely. This isn't a fee you can negotiate with the lender, because they're just passing on the costs from the appraisal company. You'll also see a small but mandatory credit report fee. The lender needs to pull your credit history and scores from the three major bureaus, Equifax, Experian, and TransUnion, to verify you're a responsible borrower. This usually only costs about $30 to $50. Now we get into the legal stuff, starting with title services. This is a big one and it's often confusing. It includes two main parts: a title search and title insurance. The title search is like a background check for your property. A company scours public records to make sure there are no outstanding liens, claims, or ownership disputes on your property. They're making sure you actually have the legal right to use your house as collateral. Then you have to buy title insurance. This is an insurance policy that protects the lender in case the title search missed something. If some long-lost heir shows up years later claiming your house is rightfully theirs, the lender's title insurance policy ensures they don't lose their money. You can also buy an owner's policy to protect yourself. These title fees can easily run over $1,000, depending on your location and loan amount. Don't forget the government's cut. You'll have to pay recording fees. This is the fee your local county or city government charges to officially record your new mortgage in the public record, making it a legal document. It's usually not a huge amount, but it's another unavoidable cost. And finally, you might see something called discount points. This is one of the most important concepts to understand. 1 point costs 1% of your total loan amount. So on that $300,000 loan, 1 point would cost you $3,000. Why on earth would you pay that? Because in exchange, the lender will give you a lower interest rate for the entire life of the loan. You are essentially prepaying some of your interest upfront to get a lower monthly payment later. Whether or not this is a good idea depends entirely on how long you plan to stay in your home, which we will calculate in just a moment. So you've got all these fees: origination, application, appraisal, credit report, title insurance, recording fees, and maybe points. Together, they typically add up to 2 to 5% of your total loan amount. On that $300,000 loan, you could be looking at $6,000 to $15,000 in closing costs. That's a huge number, and seeing it for the first time can be a shock. This is where lenders get clever. You'll see advertisements for a no closing costs refinance. It sounds like a dream come true, but I'm here to tell you it's a myth. There is no such thing as a free lunch, and there is absolutely no such thing as a no-cost refinance. The costs don't just disappear. The lender is a business, they have to get paid. So they hide the costs in one of two ways. First, they might roll the closing costs into your loan balance. So if your closing costs are $10,000 on that $300,000 refi, your new loan isn't for $300,000. It's for $310,000. You're not paying cash out of pocket, which feels good, but you are now paying interest on those $10,000 in fees for the next 30 years. That $10,000 could end up costing you $20,000 or more over the life of the loan. The second and more common way is that the lender will give you a higher interest rate. The market rate might be 6%, but they'll offer you a no-cost loan at 6.5%. That extra 0.5% might not sound like much, but over 30 years, it adds up to tens of thousands of dollars in extra interest payments. That's how they recoup the closing costs and then some. They're betting you'll be so focused on not paying cash up front that you won't notice you're signing up for a much more expensive loan in the long run. So, how do you know if paying these costs is actually worth it? You need to calculate your break-even point. This is the single most important calculation you will make in the entire refinance process. It is the moment in time when your monthly savings have officially paid back your closing costs. After this point, every single month is pure, real savings in your pocket. Here's the simple formula. Take your total closing costs and divide them by your monthly savings. The result is the number of months it will take to break even. Let's do a real example. Let's say your total closing costs are $6,000. Your current mortgage payment is $2,500 a month. Your new payment after refinancing will be $2,250 a month. That's a monthly savings of $250. So, you take the $6,000 in costs and divide it by the $250 in savings. The answer is 24. It will take you exactly 24 months or 2 years to break even. This number is your North Star. If you plan on staying in your house for 5, 10, or 20 years, this refinance is a fantastic financial decision. After that 2-year mark, you'll be saving a clear $250 every single month. But if you think you might sell the house or move in the next year and a half, this refinance would be a terrible mistake. You would have spent $6,000 just to move before you ever recoup that cost. You would have literally lost money. This break-even calculation is your power. It cuts through all the marketing jargon and tells you, in plain black and white, whether the deal is right for your specific situation. Now, remember how I said some fees are negotiable? Your leverage comes from shopping around. You must get an official loan estimate from at least 3 different lenders. This is a standardized 3-page government form that breaks down every single estimated cost. By law, every lender has to use the exact same form. This makes it incredibly easy to compare offers side by side. You can see which lender is charging a higher origination fee, or who has lower third-party service costs. You can then take the best offer and use it as a weapon. Call up the other lenders and say, "Look, I have a loan estimate here from XYZ Bank, and they're only charging a 0.5% origination fee. Can you match that?" More often than not, they will, because they want your business. You can save thousands of dollars with just a few phone calls. Understanding these costs, debunking the no-cost myth, and calculating your break-even point transforms you from a passive consumer into an empowered homeowner. You're now in control of the process, but knowing the cost is only half the battle. Now you need to know if you can even get approved in the first place. What are lenders actually looking for when they pull up your file? What magic numbers do you need to hit? It all comes down to 3 critical pillars. Think of these as the 3 legs of a stool. If any one of them is weak, the whole thing can wobble and fall over. These are the core metrics every single lender in the United States will use to judge your application. They are your credit score, your debt-to-income ratio, and your loan-to-value ratio. Let's break down each one so you know exactly where you stand. First up, the big one, your credit score. We've all heard of it, but what is it, really? Think of your credit score as your financial trustworthiness score. It's a 3-digit number, usually ranging from 300 to 850, that tells a lender one simple thing. How likely are you to pay back the money you borrow on time? It's not a measure of your wealth or your character. It is purely a statistical prediction of your future behavior based on your past actions. For a lender, this number is everything. It's their first line of defense against risk. A high score tells them you're a safe bet. A low score flashes a warning sign, suggesting they might have to chase you for payments down the road. So what's the magic number? While every lender has slightly different goalposts, there are some widely accepted tiers you need to know about. The absolute gold standard, the VIP section of refinancing, is a credit score of 740 or higher. If you're in this range, you are a lender's dream client. You'll be offered the best interest rates, the lowest fees, and the smoothest process. You have the most negotiating power. The next tier down is from about 700 to 739. This is still considered very good. You'll qualify for excellent rates, maybe not the absolute rock bottom best, but very competitive. You're a low-risk borrower and shouldn't have much trouble getting approved. Now we get into the 660 to 699 range. This is generally considered the fair or average credit bucket. You can absolutely still get a refinance in this range, but this is where you'll start to see a noticeable difference. Your interest rate will be higher, and the lender might ask for more documentation or have stricter requirements on the other 2 pillars we're about to discuss. Below 660, things get significantly tougher. It's not impossible, especially with government-backed programs like an FHA or VA loan, but for a conventional refinance, it becomes very challenging. The rates you're offered, if you are approved, could be high enough to wipe out any potential savings from refinancing in the first place. Your credit score is built on a few key factors. Your payment history. Are you paying your bills on time every time? Your credit utilization. How much of your available credit card limit are you using? And the length of your credit history. The single most important thing you can do before you apply for a refinance is to pull your credit report. You can get it for free from the official government-mandated site. Check it for errors, see where you stand, and if your score is on the borderline, it might be worth waiting a few months to pay down some credit card balances and ensure every single payment is on time. A 20-point jump in your score could save you tens of thousands of dollars over the life of your new loan. Okay, that's Pillar 1. Now for Pillar 2, your debt-to-income ratio, or DTI. If your credit score is about your past reliability, your DTI is about your present capacity. It answers the lender's question. Can you actually afford this new mortgage payment right now, given all your other financial obligations? It's a simple but brutal calculation. Lenders add up all your monthly debt payments, your current mortgage, car loans, student loans, credit card minimum payments, any personal loans, and they divide that total by your gross monthly income, which is your income before taxes are taken out. The resulting percentage is your DTI. Let's say your gross monthly income is $6,000. And let's say your total monthly debt payments, mortgage, car, and credit cards, add up to $2,700. You would divide $2,700 by $6,000, which gives you 0.45. Your DTI is 45%. So what's the magic number here? The golden rule for most conventional loans is a DTI of 43% or less. This is the line in the sand where studies have shown borrowers have a manageable amount of debt and are less likely to run into trouble making their payments. Some lenders might stretch this to 45%, or even up to 50% if you are an exceptionally strong borrower in other areas, like having that 740+ credit score and a ton of cash and savings. But if you want the smoothest approval process, aiming for 43% or lower is your safest bet. A high DTI is a massive red flag for lenders. It tells them you're financially stretched thin. You have no wiggle room. If an unexpected expense pops up, like a medical bill or a car repair, you might have to choose between paying that and paying your mortgage. And that's a risk they do not want to take. Unlike your credit score, which can take time to improve, you can directly impact your DTI right now. You can either decrease your debts by paying off a small loan or a credit card, or you can increase your income, perhaps by documenting a side hustle or a recent raise. Calculating your DTI is a critical step to take before you even fill out an application. This brings us to the third and final pillar, your loan-to-value ratio, or LTV. This one is all about the asset itself, your home. LTV measures how much you want to borrow compared to the home's current appraised value. It's a measure of your skin in the game. It's your equity. Here's how it works. Let's say your home was just appraised for $400,000. And your remaining mortgage balance, the amount you want to refinance, is $320,000. To find your LTV, you divide the loan amount by the home's value. So $320,000 divided by $400,000 equals 0.80. Your LTV is 80%. This means you have 20% equity in your home. Why do lenders care so much about this? Because your equity is their safety cushion. It's their insurance policy. In a worst-case scenario, if you stop making payments and the bank has to foreclose and sell your house, that 20% equity buffer makes it much more likely they'll get all their money back, even if they have to sell the home at a slight discount. If you have very little equity, say just 5%, the risk for the lender skyrockets. A small dip in the housing market could mean they would lose money if they had to foreclose. For this reason, the magic number for LTV on a conventional refinance is 80% or lower. Having at least 20% equity is the key that unlocks the door to avoiding something every homeowner dreads: private mortgage insurance, or PMI. PMI is an extra monthly fee you are forced to pay that provides zero benefit to you. It is insurance that you pay for to protect the lender in case you default. If you try to refinance with less than 20% equity, the lender will almost certainly require you to pay PMI on your new loan, which can add $100 or more to your monthly payment, potentially canceling out the savings you were trying to achieve. Getting your LTV to 80% or below is one of the most important goals in the refinancing game. So there you have it. The 3 pillars of refinance approval. Your credit score, showing your history of reliability. Your debt-to-income ratio, showing your current ability to pay. And your loan-to-value ratio, showing the lender's safety cushion in your home's equity. Lenders look at these 3 things together to build a complete financial picture of you. A stellar credit score might help you get approved with a slightly higher DTI. A huge amount of equity might make a lender overlook a slightly bruised credit history. They work in tandem. Understanding these 3 numbers puts you in the driver's seat. You're no longer guessing. You know what they're looking for and you know where you stand. Okay, so you've checked your numbers. Your credit is solid, your DTI is in the green, and you've got equity. You're ready to go, right? Not so fast. There's a hidden 4th element that can make or break your application, and it has nothing to do with your personal finances. It's the documentation, the paper trail. What exact paperwork do you need to gather before you even speak to a lender to make the process 10 times smoother and faster? That's what we're digging into next. All right, let's build your fortress of paperwork. Think of this not as a chore, but as assembling your refi-ready dossier. This is your secret weapon. When a loan underwriter looks at your file, they're not just looking at numbers. They're trying to read a story about your financial reliability. Your job is to make that story crystal clear, compelling, and undeniable. Having this dossier ready before you even fill out an application will make you a lender's dream client. It shows you're organized, serious, and it dramatically cuts down on the back and forth that drives so many people crazy. We're going to break this down into 4 core pillars: income, assets, debts, and the property itself. First, and most importantly, is your proof of income. This is the engine of your application. The lender's primary question is, can this person consistently afford the new monthly payment? Your documents are the answer. For the vast majority of you who are W-2 employees, this is relatively straightforward. You'll need your 2 most recent pay stubs. These need to show your year-to-date earnings. Why? Because it confirms your current employment and pay rate. Next, you'll need your W-2 forms from the last 2 years. The W-2 is the gold standard for lenders because it's a government document. It's a third-party verification from your employer to the IRS, proving your income story. Finally, you'll likely need your last 2 years of federal tax returns, all pages. Yes, all of them, even the blank ones. Lenders need to see the full picture, including any side income, deductions, or losses you might have reported. Now, for my self-employed friends, the gig workers, the freelancers, the small business owners, listen closely because this is where many applications hit a snag. Your income story is more complex, so your documentation needs to be even stronger. You won't have W-2s, so your last 2 years of full federal tax returns, both personal and business, if you file them separately, are non-negotiable. Lenders will typically average your net income over those 2 years to determine your qualifying income. This is critical. They look at your net income, after all your business expenses and write-offs, not your gross revenue. In addition to your tax returns, you'll likely need a year-to-date profit and loss statement, or a P&L for your business. This shows the lender how your business is performing this year, right now. You'll also want to have your business bank statements ready, as well as any 1099 forms you've received. The key here is demonstrating a stable and predictable income stream. If your income jumped significantly last year, or if it fluctuates wildly, be prepared to write a letter of explanation, or LOX. This is simply a signed letter explaining the situation. Maybe you landed a huge contract, or your business is seasonal. Just explain it clearly and concisely. Proactively providing this information builds trust and prevents delays. The second pillar of your dossier is proof of assets. This tells the lender about your financial cushion. It shows them you have the funds to cover closing costs, and that you have reserves in case of an emergency. This is your financial safety net. You'll need your 2 most recent bank statements for all of your checking and savings accounts. And I mean all of them. Don't leave one out because it only has a few $100s in it. They want a complete picture. And here is a massive pro tip. Make sure you provide every single page of the statement, even if the last page is blank or just has legal jargon on it. A missing page is one of the most common and easily avoidable delays. Lenders will scrutinize these statements for what they call large unverified deposits. A random $5,000 cash deposit a month before you apply is a huge red flag. To them, it looks like you might have borrowed money from an unofficial source to qualify, which is a big no-no. If you did receive a large sum of money as a legitimate gift from a family member, for example, you'll need to source it with a gift letter and evidence of the transfer. The lesson: in the months leading up to a refinance, try to keep your bank accounts clean and simple. Avoid large cash deposits or unusual transfers. Beyond your bank accounts, you'll also need statements from any other asset accounts. This includes your 401k, IRAs, brokerage accounts, or any other investments. You don't need to cash these out. The lender just wants to see that you have these assets available, adding another layer of financial strength to your story. Pillar number 3 is all about the property itself, the collateral for the loan. The lender needs to be confident in the asset they're lending against. First, you'll need a copy of your current homeowner's insurance policy declaration page. This proves the home is insured to the proper value. You'll also need your most recent property tax bill. This shows the lender what your tax liability is, which they will factor into your total monthly housing expense. Next, find your most recent mortgage statement for your current loan. This is crucial as it shows your current loan balance, your interest rate, and whether you're paying for private mortgage insurance or PMI. This statement is the baseline from which your entire refinance is calculated. And for those of you living in a condo, a townhouse, or a neighborhood with a homeowners association, you'll need your HOA statement. It should show your monthly or annual dues and provide contact information for the association. Lenders need to factor this payment into your debt-to-income ratio, so it's a required piece of the puzzle. Finally, we arrive at the 4th pillar, your debts and credit profile. While the lender will pull your official credit report, you are the captain of this ship. You need to know what's in that report before they do. You can get your free credit reports from the official government-mandated site, annualcreditreport.com. Review it for any errors, inaccuracies, or surprises. If you have any recent blemishes, a late payment, a collection account, have that letter of explanation ready. Don't wait for the underwriter to ask you about that 30-day late payment on your car loan from 6 months ago. Address it head-on. Explain what happened, that it was a one-time issue, and that it has been resolved. Being proactive shows responsibility. You'll also need to be prepared to document any other major debts. This includes things like student loans, car loans, and credit card statements, especially if you have large balances. If you pay alimony or child support, you'll need a copy of your divorce decree or court order detailing the terms of the payment. Remember, the goal is transparency. The underwriter's job is to uncover risk. By laying all your cards on the table, documented and explained, you make their job easier and your approval faster. So there it is. Your Refi-ready dossier. Proof of income, proof of assets, property documents, and your credit profile. Gathering these items is the single most productive thing you can do to ensure a smooth, fast, and successful refinance. It transforms you from a passive applicant into a prepared partner in the process. Now that you've built this fortress of paperwork, you're armed and ready to approach a lender. But before you make that call, there's a critical question we have to answer. What is this actually going to cost? We hear terms like closing costs, points, and origination fees thrown around, but what do they really mean? How much cash will you actually need to bring to the table, or can it all be rolled into the loan? The hidden fees and complex costs of refinancing are where many homeowners get taken advantage of. So in the next part, we are going to pull back the curtain and demystify every single line item on your loan estimate. We'll expose the junk fees and show you how to calculate the true cost of your refinance, so you can walk into any negotiation with the confidence of an expert. All right, let's open up this document. This 3-page form is called the loan estimate. By law, a lender has to send you this within 3 business days of you submitting a loan application. This isn't a final approval, but it is their binding offer, and it's the single most important document you will receive in the entire refinance process. Think of it as the price tag for your new mortgage. Our goal is to make you fluent in the language of this form, so you can spot a good deal from a bad one in under 60 seconds. Let's start on page 1 right at the top. You'll see the big, bold numbers: loan amount, interest rate, and monthly principal and interest. This is what most people focus on. It's the shiny lure. The lender wants you to see that low monthly payment and get excited. And you should. But this is only part of the story. Right below that, you'll find projected payments. This is your true estimated monthly outlay. It includes not just your principal and interest, but also estimations for your homeowner's insurance and property taxes. This total is often called PITI: principal, interest, taxes, and insurance. If your new loan requires you to have an escrow account, this is the number you need to budget for every single month. Now look to the right side of page 1. You'll see a box called Costs at Closing. This is where the real game is played. It gives you 2 headline figures: estimated closing costs and estimated cash to close. The estimated closing costs is the total amount of fees you're paying for the privilege of getting this loan. The cash to close is how much money you physically need to bring to the table, or in many refis, how much will be rolled into your new loan balance. These 2 numbers are the sum of everything that's detailed on page 2, which is where we're headed next. This is where the money is hidden. Okay, flip to page 2. This is the heart of the loan estimate. It's a detailed breakdown of all those closing costs. Let's break it down box by box. Box A is origination charges. This is pure profit for the lender. It's what they charge you for creating or originating the loan. You will almost always see a percentage of the loan amount listed here as points. 1 point is equal to 1% of the loan amount. Sometimes you pay points to get a lower interest rate. This is called buying down the rate. Other times, the lender just charges points as a standard fee. Below that, you might see a list of other fees: application fee, underwriting fee, processing fee, administration fee. Let me be crystal clear. These are all different names for the same thing: the lender's profit. An underwriting fee is the cost for their employee to review your file. A processing fee is for their other employee to shuffle the papers. It doesn't matter what they call it. This entire box A, is highly negotiable. This is your number 1 target. When you hear about no-fee refinances, it often means the lender is waiving or reducing the fees in this box, usually in exchange for a slightly higher interest rate. Now let's move to box B: services you cannot shop for. This sounds rigid, but it's logical. These are services that the lender requires from a specific third-party professional to approve your loan. The most common ones are the appraisal fee, the credit report fee, and the flood certification fee. The lender has an established relationship with these companies and needs to control the process to ensure it meets their standards. You can't tell your lender, "Hey, my cousin Vinny does appraisals, let's use him." Doesn't work that way. However, just because you can't shop for these services doesn't mean you can't question them. If an appraisal fee seems astronomically high, you can ask why. You can compare it to the fees on another lender's loan estimate. Sometimes, lenders will mark up these third-party fees. It's less common, but it happens. So keep an eye on these. Next is Box C, and this is where you can become a hero for your own wallet. Box C is services you can shop for. This is a list of required services, but the lender is legally required to let you choose your own provider. The biggest item here is almost always title insurance. There will be a lender's title insurance policy, and sometimes a settlement or closing agent fee. The lender will provide you with a list of their preferred providers, and they'll put that provider's cost on the loan estimate. But you are under no obligation to use them. You can call 3 other title companies in your area and ask for a quote. You can often save hundreds, sometimes even over $1,000 right here. The lender is counting on you not to bother. Don't fall for it. A few phone calls here can be the most profitable hour you spend all year. Alright, let's scroll down the page. You'll see sections for taxes and other government fees like recording fees. These are set by your state or county. They are what they are. You can't negotiate with the Department of Records. This is a fixed cost of doing business. Then you get to the prepaids and initial escrow payment at closing. This section confuses almost everyone, but it's simple once you understand it. This is not a fee. This is your money that you are prepaying into an account. Think of it like this. The lender is going to be responsible for paying your property taxes and homeowners insurance on your behalf. To do that, they need to make sure there's enough money in your escrow account when those bills come due. So, at closing, you have to deposit a few months' worth of those payments into the account to give it a starting cushion. You're also prepaying any interest that will accrue between your closing date and the end of the month. Again, this isn't a fee the lender pockets. It's your own money being set aside for your own future bills. The amount will vary wildly depending on what time of year you close and when your property taxes are due, but it is a real cost you need to be prepared for. So, you add up Box A plus B plus C and all the other costs and you get your total closing costs. This brings us to the most important comparison tool on the entire form, the APR. You've seen it 100 times. Interest rate and right next to it APR or annual percentage rate. They're always different and the APR is always higher. Why? The interest rate is simply the cost of borrowing the money. It's the percentage used to calculate your monthly principal and interest payment. The APR, on the other hand, is a more holistic measure of the loan's cost. It takes the interest rate and then factors in most of the closing costs, the origination fees, the points, and other lender charges, and expresses that total cost as an annual percentage. Think of it this way: imagine 2 flights to Hawaii. Flight A costs $500. Flight B costs $450. You'd pick Flight B, right? But what if Flight A includes 2 checked bags for free, while Flight B charges you $60 for each bag? Suddenly, Flight B's total cost is $570. It's more expensive. The ticket price is like the interest rate. The total cost with all the baggage fees included is like the APR. The APR is the all-in price. When you are comparing 2 loan offers, the APR is often a much better indicator of which loan is truly cheaper over the long run. A loan with a super low advertised interest rate might have such high fees that its APR is actually higher than a competitor's offer. This is the number that cuts through the marketing noise and tells you the real story. Now you can read the battlefield. You know where the profit centers are, you know what's negotiable, and you know the difference between a fee and your own money. You can look at any loan estimate and understand the true cost. But having one loan estimate is like having one piece of the map. The real power comes when you have 2 or 3 or 4 of them, and you can leverage them against each other to force the lenders to compete for your business. This is where the game truly begins. This is the moment you transform from a passive loan applicant into the CEO of your own mortgage. You are now in the driver's seat because with multiple official loan estimates in hand, you have the ultimate negotiating tool: leverage. Lenders expect you to just take their first offer. They count on it. But we're not going to do that. We are going to orchestrate a competition where the only winner is you. The strategy is simple, but it requires a bit of organized effort. Your goal is to get at least 3, ideally 4 or 5, official loan estimates from a diverse set of lenders within that 14-day shopping window. Why diverse? Because different types of lenders have different business models and cost structures. Get a quote from a big national bank like a Wells Fargo or a Chase. Get one from a local or regional credit union. Get one from an online-only lender like Rocket Mortgage or Better. And absolutely get one from an independent mortgage broker. Each one fishes in a slightly different pond, and you want to see what all of them can catch. Once the loan estimates start rolling into your email inbox, it's time to become an analyst. Don't just glance at the interest rate. Open up a simple spreadsheet or grab a legal pad. For each lender, you're going to write down 4 key numbers: the interest rate, the APR, the total for Box A origination charges, and the total for Box C services you can shop for. These are your battleground statistics. Let's say lender A offers you 6.5% with $3,000 in Box A. Lender B comes in at the same 6.5% rate, but their Box A is only $1,800. And lender C offers a slightly higher rate, 6.625%, but their Box A is an incredibly low $950. Right away you can see the landscape. Lender A is expensive. Lender B is the current frontrunner on costs for that 6.5% rate. Lender C has the lowest fees but a higher rate. Now the chess match starts. You are going to contact lender A, and you're going to be polite, professional, and direct. You can do this over the phone, but I strongly recommend email. It creates a paper trail and makes it easy to forward documents. Your email will say something like this: "Hi, a loan officer name. Thank you for sending over the loan estimate. I'm currently reviewing it alongside other offers. I see your rate is 6.5%, with origination charges in Box A totaling $3,000. I have another official loan estimate from a different lender for the exact same 6.5% rate, but their origination charges are only $1,800. I've attached it for your review. I prefer to work with your company, but there's a $1,200 difference in fees that I need to account for. Is there anything you can do to match or beat their offer on the closing costs?" And then you hit send, and you wait. What you've just done is call their bluff. You've shown them with concrete proof that a competitor is willing to do the exact same loan for significantly less money. You've targeted Box A, the lender's direct profit center. These fees, the processing fee, the underwriting fee, the application fee, are almost pure margin. They have immense flexibility here. They can't magically change the cost of a third-party appraisal, but they can absolutely reduce their own fees to win your business. 9 times out of 10 you will get a response. The loan officer will go to their manager, and they'll come back with a revised offer. Maybe they can't match the $1,800 exactly, but they come down to $2,000. That's an instant $1,000 savings for one email. Or maybe they match it completely, but we're not done. Now you take your new best offer and you go to the next lender. Remember lender C with the higher rate but super low fees? Now you email them. "Hi, a loan officer name. I'm reviewing your offer. I really appreciate how low your lender fees are. Right now, I have a competing offer at a lower rate of 6.5%, and they've matched the closing costs. Is there any possibility of you matching the 6.5% interest rate while keeping your fees as low as they are? If you could do that, you would be my top choice." You see the dance? You're using one lender's strength in one area to negotiate with another. You're using lender B's low costs to get lender A to lower their costs. Then you're using lender A's low rate to get lender C to lower their rate. You are systematically forcing them to strip away their profit margin and present you with the leanest, most competitive loan possible. During this process, you will hear some common pushback. A loan officer might say, "Well, our service is better. We close on time." Your response should be, "I appreciate that, and good service is important. But is your service worth an extra $2,000 out of my pocket compared to another reputable lender?" The truth is, the process is highly standardized, and once your loan is closed, it will almost certainly be sold to a massive servicing company anyway. The person you're talking to now will be out of your life in 30 days. Your loan and its cost will be with you for years. Another common tactic is for them to try and rush you. "This offer is only good for today. You need to commit now." Don't fall for it. The official loan estimate is good for 10 business days. That is the law. You can calmly reply, "I understand. As per federal regulations, I have 10 business days to review the loan estimate, and I'll be making my final decision within that time frame." This shows them you know the rules of the game. The key is to always be negotiating from a position of power, and that power comes from having official written offers from their competitors. Don't just say, "Another lender offered me a better deal." Prove it. Black and white. PDF attachment. This removes all ambiguity and forces them to deal with facts, not sales talk. Let's be crystal clear about where you can and cannot negotiate. Box A, origination charges. This is your number one target. It's almost 100% negotiable. Box B, services you cannot shop for. This is tougher. It includes things like the appraisal, credit report, and flood certification. You can question these fees, especially if one lender's appraisal fee seems wildly higher than another's, but there's less wiggle room. Sometimes a lender will offer a lender credit to offset these costs, which is another way of saying they're cutting their profit from Box A to cover a fee in Box B. It all comes from the same pot. Box C, services you can shop for. This is primarily title insurance and settlement services. And this is a huge area for savings that we're going to dedicate an entire future part of this series to. Because shopping for your own title company is a power move most homeowners don't even know they have. For now, just know that you can and should challenge these figures. By going through this process for a few days, you can literally save thousands, or even tens of thousands of dollars over the life of your loan. A quarter-point reduction in your interest rate on a $400,000 loan is over $20,000 in interest savings over 30 years. Slashing $1,500 from your closing costs is $1,500 in your pocket, right now. This is the single most profitable hour of work you will do all year. After a few rounds of this, you will have a clear winner. One lender will have emerged with the best combination of rate and fees. They've sharpened their pencil, they've met the competition, and they've earned your business. You've fought the battle, you've won the negotiation, and you have a champion lender ready to go. But a great offer is useless until it's locked in stone. You have to formally tell the lender, yes, I accept. Lock me in. And the world of rate locks is a minefield of its own, with hidden traps that can cost you everything you just saved. Getting the lock wrong is like fumbling the ball on the 1-yard line, turning a certain victory into a costly defeat. So let's talk about that fumble. The rate lock isn't just a piece of paper. It's a shield. It's the one thing that stands between you and the wild, unpredictable beast that is the bond market. Every single day, interest rates twitch up and down based on inflation reports, Federal Reserve meetings, global events, things you have absolutely no control over. Without a rate lock, you are floating, completely exposed. You might find an amazing rate on Monday, submit your application, and by Friday a bad jobs report comes out and that rate is just gone, vanished. And it might not come back for years. A rate lock is a promise from your lender. They are saying, for a specific period of time, we guarantee you this interest rate on this loan program for these points, provided your financial situation doesn't change. It's your fortress in a storm, but the walls of that fortress have a timer on them, and that timer is the most critical and most misunderstood part of the entire process. This is the lock period. Lenders will typically offer you a lock for 15, 30, 45, or 60 days. Now you might think, shorter is better, right? Let's get this done fast. And your lender might even encourage that thinking. A 15-day or 30-day lock is often slightly cheaper than a 45 or 60-day lock. The lender is taking on less risk by guaranteeing a rate for a shorter window, so they pass a tiny bit of that savings on to you. It might be an eighth of a point cheaper or a slightly lower interest rate. And the temptation is to grab that little bit of extra savings. This is the first trap. It's a siren song luring you towards the rocks. A refinance is not a sprint. It's a bureaucratic obstacle course. There's the application processing, underwriting review, the appraisal, the title search, and the final scheduling of the closing. Each one of these steps is a potential delay. What if the appraiser is booked out for 2 weeks? What if underwriting comes back with a question about a deposit you made 6 months ago? What if there's a small lien on your title from a contractor you forgot you even hired 10 years ago? Any one of these common, everyday hiccups can add a week or more to your timeline. Suddenly, your safe 30-day lock has only 5 days left on it, and you haven't even been cleared to close. This is when the panic sets in, because when that lock expires, you are thrown back out into the open waters of the current market. If rates have stayed the same or gone down, you're fine. But if rates have gone up, even 0.25%, you have a catastrophic problem. Let's put that in real numbers. On a $400,000 loan, a 0.25% increase in your interest rate is about $60 a month. That doesn't sound like a lot, but $60 a month for 30 years is $21,600. You just lost over 20 grand, evaporated into thin air, because you tried to save a couple $100 on a shorter lock period. You fumbled on the 1-yard line. So how do you avoid this? You have to be ruthlessly realistic. Before you even think about locking, ask your loan officer, what is your average turn time for a refinance from application to closing? Don't accept a vague, "Oh, we're pretty fast." Ask for a number. If they say 35 days, do not, under any circumstances, lock for 30 days. Give yourself a buffer. Lock for 45 days. Yes, it might cost you a tiny fraction more upfront, but you are buying yourself peace of mind, which in the world of mortgages is priceless. You are buying insurance against the unexpected. But what if you're in a really volatile market? Rates are jumping up and down every day. You're terrified to float, but you're also terrified of locking in right before rates take a sudden dip. This is where lenders will dangle another shiny object in front of you. The float down option. Sounds like the perfect solution. They'll tell you, lock your rate today to protect yourself. And if rates go down during your lock period, we'll let you take the lower rate. Sounds like a win-win. But the float down is not a charity. It's a product and it has a price. Sometimes it's a flat fee like $500. Sometimes they build the cost into your interest rate, meaning everyone who takes a loan with that lender is paying a slightly higher rate to cover the cost of the few who use the float down. And there are always rules. The rate usually has to drop by a significant amount, like 0.25%, before you can exercise the option. You can often only do it once. And you usually have to do it within a specific window, like at least 15 days before your closing date. A float down can be a powerful tool, especially if you believe rates are headed lower, but you can't stomach the risk of floating. But you have to understand the cost and the fine print. It's not a magic wand. It's an expensive insurance policy. The most dangerous trap, however, is the one that springs when you're already in trouble. Let's go back to our scenario. You chose a 30-day lock. There was an appraisal delay. Now you have 3 days left on your lock and the closing is still a week away. Your lender knows you're in a corner, so they make you an offer. Don't worry, they'll say. We can extend your lock for you. Sounds like they're doing you a favor. They are not. They are charging you for it. A lock extension is almost never free. They might charge you a flat fee, say 0.25% of the loan amount. On that $400,000 loan, that's a $1,000 fee to extend for another week or two. Sometimes they charge it in points, which means your closing costs just went up. Or, the most insidious version, they'll extend your lock but at a slightly worse interest rate. This is where you absolutely must read the fine print of your rate lock agreement before you sign it. It should spell out the extension policy. What does it cost? How is it calculated? How many times can you extend? If it's not in that document, get it from your loan officer in writing. Because if you don't, you are giving them a blank check. They know that if rates have gone up, you have no choice but to pay their extension fee. Your only other option is to let the lock expire and take the new, higher market rate, which could cost you tens of thousands of dollars more. They have all the leverage. The key to disarming all of these traps is preparation. The reason closings get delayed is because of surprises found in your documents or on your property. So, the single best strategy is to get all of your documents to the lender, every pay stub, every bank statement, every tax return, and get them through the initial underwriting review before you lock your rate. Get the appraisal ordered and completed before you lock your rate. By clearing these major hurdles up front, you dramatically reduce the chances of a delay. You shrink the timeline from a chaotic 45 days to a much more predictable 15 or 20 days. Now, a 30-day lock isn't a gamble. It's a fortress with time to spare. You've taken control of the clock. Locking your rate feels like the end of the journey. You've shopped, you've applied, you've secured your savings. Feels like you've crossed the finish line. But you haven't. You've only secured the terms of the deal. Now you have to actually close that deal. And the path from the rate lock to the closing table is its own journey. A world of mind-numbing paperwork, confusing fees, and last-minute curveballs designed to separate you from your money. This is the final boss battle. Surviving the closing. The first weapon the final boss throws at you is an avalanche. An avalanche of paper. It's called your initial closing disclosure, and it lands in your inbox with a thud. A dense 5-page document filled with numbers and jargon that seems intentionally designed to make your eyes glaze over. This is not just another form. This document is the Rosetta Stone of your refinance. It is the single most important piece of paper you will see in this entire process. And the lender is legally required to give it to you at least 3 business days before you're scheduled to sign. This isn't a courtesy. It's a federal law called the TRID rule. And it was created because for decades, lenders would slide a completely different set of numbers in front of buyers at the last second. knowing they were too tired and too committed to back out. So let's be clear. This 3-day review period is not a suggestion. It is your legal right. It is your government-mandated superpower. Do not waive it. Do not ignore it. Your mission, should you choose to accept it, is to take this closing disclosure and compare it line by line to the loan estimate you received at the very beginning of this journey. They should look almost identical. This is your moment of truth. This is where you find out if the smooth-talking loan officer you spoke to 6 weeks ago was telling you the truth. Your interest rate, your loan amount, your monthly payment, these are the big-ticket items on page 1. They should match your rate lock agreement perfectly. If they don't, you stop everything and you call your loan officer immediately. No excuses. No stories. It's either what you agreed to or it's a mistake that needs fixing. But the real battle is fought in the trenches of page 2. This is the breakdown of closing costs, a section so notoriously confusing it feels like a psychological test. It's divided into a dozen little boxes, each with a fee that seems to have materialized out of thin air. Let's demystify this minefield. These costs fall into a few main categories. First, you have the lender's fees. This is what you're paying the bank for the privilege of them creating money out of thin air to give to you. You'll see an origination fee, which is their main profit. You might see an underwriting fee, a processing fee, an admin fee. These are often just different names for the same thing, profit. These are the fees you should have negotiated up front. If new phantom fees have suddenly appeared here that weren't on your loan estimate, that's a massive red flag. Next are the third-party services. These are fees for services the lender can't perform themselves. Think of the appraisal fee, the credit report fee, the flood certification fee. By law, the lender can't mark these up. They can only charge you what they were actually charged. But you still need to check them. Did they charge you for 2 credit reports? Is the appraisal fee what you were quoted? It's death by 1,000 cuts, and you have to be the one to stop the bleeding. Then you enter the twilight zone, title and settlement fees. This is the single most confusing, opaque, and wildly variable part of the entire closing process. You'll see a charge for a settlement agent or closing fee. This is the person or company, often a title company or an attorney, who acts as the neutral third party, the referee in this transaction. They handle the money and the paperwork to make sure everything is legal and above board. You'll also see a monster fee called lender's title insurance. This is a mandatory insurance policy you are forced to buy, not for your own protection, but for the lenders. It protects them in the infinitesimally small chance that someone from the past, a long-lost heir of the person who owned your land in 1890, for instance, comes forward and claims they actually own your property. It's a racket, frankly, but it's a non-negotiable one. You have to pay it. What you can do, and what most people don't know, is that you can often shop for your own title company. The lender will recommend their preferred partner. But you can sometimes save hundreds, even $1,000 or more, by finding a more competitive company on your own. It's one of the last great secrets of saving money on a mortgage. After the title fees, you'll see government taxes and recording charges. These are for the privilege of letting your county and state know that you have a new mortgage. They are what they are. You can't negotiate with the Department of Motor Vehicles, and you can't negotiate with the county clerk. Just make sure the numbers are correct. Finally, we come to the section that trips everyone up: prepaids and initial escrow. This isn't a fee. It's your own money being set aside. Prepaids include the daily interest on your new loan from the day you close until the end of the month. It also includes paying for a full year of your homeowner's insurance premium upfront. Then there's the initial escrow payment. The lender is establishing a savings account for you, called an escrow account, to pay your future property taxes and homeowner's insurance. To get that account started, they need a cushion, usually a few months' worth of payments. This is the number that causes the most sticker shock. People see a charge for thousands of dollars and think it's a fee. It's not. It's your money going into an account with your name on it that will be used to pay your bills. The key is to understand how they calculated that cushion. Sometimes they're overly cautious and take too much. You need to ask them to show you the math. Once you've gone through this document with a fine-tooth comb, once you've questioned every fee and confirmed every number, you give your lender the green light. They'll prepare the final package, a stack of documents an inch thick, and send it to the settlement agent. You'll schedule your closing. You might go to a title company office, or a mobile notary might come to your kitchen table. You're exhausted. You've been through the ringer. You just want it to be over. And that is the most dangerous moment of the entire process. Because at the closing table, You are presented with that same inch-thick stack of paper. The notary, who is usually a very nice person, will say, "Okay, sign here, initial here, and sign here." They'll flip through pages with the speed of a blackjack dealer. The pressure to just sign, to just get it done, is immense. Do not give in. This is not a ceremony. It's a final inspection. You ask for a moment. You pull out your copy of the closing disclosure, the one you already approved. You check the key documents in the stack against your approved version. The note, which is your actual promise to pay. The mortgage or deed of trust, which is the document that says they can take your house if you don't pay. You check the interest rate. You check the loan amount. You check the monthly payment. You make sure nothing has changed. 99 times out of 100, everything is fine. But you are not playing the odds. You are protecting your single largest asset. You are looking for that one time, that one clerical error that adds a quarter point to your interest rate or $1,000 to your closing costs. When you are satisfied, and only then, you pick up the pen. You'll sign your name so many times your hand will cramp. You'll pass over a cashier's check for your closing costs and prepaids. And then it's over. A quiet moment of anticlimax. The notary packs up their bag. You're left with a copy of the mountain of paper you just signed. And you're a homeowner with a new, better mortgage. But you're not quite done. There's one last piece to the puzzle, one final step that, if you forget it, can create a world of financial pain and a black mark on your credit report. It's about what happens after you walk away from the closing table. It's called the payoff verification, and it's the single most overlooked step in the entire refinancing process. When you sign those closing documents, your new lender doesn't hand you a giant check to go pay off your old loan. They handle it themselves. They wire the money directly to your old mortgage company to settle your debt. In a perfect world, this happens flawlessly every single time. The wire goes through, the old account is closed, and you move on with your new, better loan. But we don't live in a perfect world. Wires can be delayed. Account numbers can be mistyped. A back office employee at one of the banks can make a simple clerical error. And if that happens, the payment to your old lender never arrives. But here's the terrifying part. Nobody calls to tell you. Your old lender doesn't know you refinanced. They just know your monthly payment is due. Your new lender assumes the wire went through and their job is done. You, the homeowner, are happily waiting for your first new, lower mortgage payment to be due next month, completely unaware that a financial time bomb has just been activated. A few weeks go by, and you get a letter from your old mortgage company. It's a late notice. You probably think it's a mistake, a piece of junk mail that crossed in the system. You might even throw it away. Then another one comes, this time with a bigger late fee. Then the phone calls start. Suddenly, you're getting notices of delinquency on a mortgage you thought you no longer had. And because you're not paying it, your old lender reports a 30-day late payment to the credit bureaus. Your credit score, the one you worked so hard to perfect to get this great new rate, plummets by 50, 80, maybe even 100 points. All the while, you're still legally obligated to make the payment on your new mortgage. So now you're facing the prospect of having to pay 2 mortgages at once, plus a mountain of late fees just to stop the bleeding. This is the world of financial pain I'm talking about. It's a bureaucratic nightmare that can ruin your finances and your credit for years. And it is completely 100% avoidable. Here is your post-closing checklist. This is your final mission. Do not skip a single step. First, 1 to 2 weeks after you've closed, you need to proactively call your old lender. Don't wait for them to contact you. Get on the phone and ask one simple question. Can you confirm that my loan account number, your old loan number, has been paid in full and the account is closed? Don't let them give you a vague answer. You want a definitive yes. If they say no, or that they haven't received the funds, you need to immediately hang up and call your new lender's closing department or your loan officer. Let them know the payoff was not received. This lights a fire under them to track the wire and fix the problem before it spirals out of control. Second, once your old lender does confirm the loan has been paid in full, your next sentence should be, "Great. Can you please mail me a paid in full letter and a copy of the release of lien?" This is non-negotiable. The paid in full letter is your personal proof. But the release of lien is even more important. A lien is a legal claim your lender has on your property. It's what allows them to foreclose if you don't pay. When you pay off the loan, that lien needs to be officially removed from your county's property records. The release of lien is the document that does this. Without it, the old lender technically still has a claim on your home, which can create a massive headache if you ever try to sell or refinance again. Get that document. Third, what about your old escrow account? Remember all that money you were paying each month for property taxes and homeowners insurance? That money is yours. Your old lender is required by law to refund it to you. They will mail you a physical check, typically within 30 to 45 days of the loan being paid off. So for the next 2 months, watch your mail like a hawk. If that check doesn't arrive, get back on the phone with the old lender and find out where it is. It could be hundreds or even thousands of dollars that belong to you. And finally, the easiest step to forget. Log in to your new lender's online portal and set up your automatic payments. Your first payment on the new loan is usually due on the first of the month following the month you closed. So if you close on May 15th, your first payment is July 1st. It's easy to lose track. Set up autopay right away so you don't accidentally start your brand new loan with a late payment. And that's it. Once you've verified the old loan is paid, gotten your confirmation documents, cashed your escrow check, and set up your new payments, you're done. You have successfully navigated the entire mortgage refinance process from start to finish. Think about the journey we've just been on together. We started at the very beginning, asking the fundamental question, why should you even consider refinancing? We broke down the big reasons: securing a lower interest rate to save tens of thousands of dollars, shortening your loan term to own your home free and clear years sooner, or tapping into your home's equity with a cash-out refi to fund major life goals. We then turned the lens inward, focusing on getting your house in order. We talked about the critical importance of your credit score, how to check it, and the small hinges that swing big doors when it comes to improving it. We demystified debt-to-income ratio, showing you how lenders see your financial obligations and how to position yourself as a low-risk, highly qualified borrower. From there, we went out into the marketplace. We uncovered the strategies for shopping for lenders, looking beyond the big banks to credit unions and mortgage brokers to find the absolute best deal, not just the most familiar name. You learned how to compare loan estimates like a pro, cutting through the noise to see the true cost of each offer. We walked step by step through the application process, gathering the mountain of paperwork, pay stubs, tax returns, bank statements, and submitting it with confidence. We faced the appraisal, understanding what the appraiser is looking for and how that valuation impacts your entire loan. We dove deep into the nerve-wracking world of underwriting, the black box where the final decision is made, and discussed the power of locking in your interest rate to protect yourself from market volatility. We stood at the finish line, preparing you for closing day, explaining the key documents like the closing disclosure, and what to expect when you finally sit down to sign your name. And just now, we completed the final crucial lap, the post-closing verification that ensures a smooth transition and protects your financial future. You've armed yourself with knowledge that the vast majority of homeowners simply don't have. You are no longer just a passenger on this journey, hoping the driver knows where they're going. You are in the driver's seat. You have the map, you have the keys, and you understand how the engine works. Refinancing a mortgage can be one of the most powerful financial moves you ever make. It's not just about changing a loan. It's about changing your life. It's about freeing up hundreds of dollars every month to invest, to save for your children's education, or to finally take that vacation you've been dreaming of. It's about building wealth, reducing debt, and taking control of your single biggest asset. The process can seem intimidating from the outside, a complex world of jargon and paperwork designed to confuse. But as you've now seen, when you break it down piece by piece, it's just a series of logical steps. Each one is manageable, each one is achievable, and you are now more than capable of handling every single one of them. So take this knowledge and use it. Whether you decide to refinance next week, next year, or just help a friend or family member understand their own options, you are now an empowered homeowner. You understand the system, you know the pitfalls to avoid, and you know the questions to ask. You're not just a homeowner anymore. You are the master of your mortgage. Now go build your future.